What is a vertical? Well, a vertical is just a combination of buying and selling either a call or a put. And we do this because it defines our risk, and we'll see how that works in a second. There's two kinds of verticals. There are short verticals, which means we sell them for a credit. Remember our terminology, short equals credit. So we sell these verticals for a credit, and this is similar to, just like before, selling calls or selling puts. Just think of the exact same thing, except in this case you'll see we actually can define our loss. But it's no different than just selling what they call naked options, just the calls and puts with the undefined risk. And there's something called long verticals, which we now know long equals debit equals cost. So long verticals are something that we buy for a cost. And this is similar to just buying calls or buying puts outright. Except you'll see in this case, by defining our risk, we actually increase our POP. So let's start with selling or shorting call verticals. When we sell a call, what do we want to happen? We want the stock price to go down. So this is a purely hypothetical example using numbers, easy numbers, so it hopefully helps explain this thing. So we're going to start over here and just assume the stock price is $100. And in this case, we're going to start with the example of selling the 100 call. Now what does that mean? We sell a call, we want the stock price to go down. So you can see here the arrows are green because if the stock price goes down from $100, we make money. On the flip side, anything above $100, you see it's red because we lose money, right? When we sell a call, we want the stock price to go down. So down is our profit, up is where we get to that undefined risk area, right? We don't know how far the stock can go up, so we don't know how much we can potentially lose. That's the part that scares us as beginning traders. So how can we fix this? We can do something called a vertical. The stock price is $100. We're selling this $100 call. Normally, anything above $100 is where we start losing money. But we're going to do something a little different here. Remember the definition of a vertical, right? It was buying and selling a call, which sounds kind of weird. So we start with the same example. We're selling a $100 call, but now we're also going to buy the 105 call. So what does that do? You see this area here called defined risk. So how does that work? Well, remember, if it goes below 100, we make money. Anything above 100, we start to lose money. But if we also buy the 105 call, when you buy a call, what do you want to happen? You want the stock price to go up. So you can see here from these green arrows that anything above 105, we start making money. Okay? So what happens is these actually cancel each other out from 105 up. Everything we lose on the sold call right here, we make on the bought call right here. So this whole area is a wash. And what happens when we do that is we define the risk. We end up with this box here. This pink area is everything that's involved with the trade. This is the most money we can make or lose as a whole right here. We've defined the risk because above 105 it washes itself out. Below 100 we still have some profit because that's what we want to happen. But here the pink area is now defined. It doesn't just go on forever if it goes up because we've bought this call to protect ourselves. So let's go to a trade page and really start hammering this down and see how this concept plays out in reality. Okay, so let's look at a trade page and go through this really in depth because it's obviously going to be the same for all the different kinds of verticals we do. They're going to be very similar. So let's start by looking at this. In this case, our stock price is $12.55. So this is the stock we're using. It's going to be the same example we just showed with the $100 stock price because that was easy. But now it's exactly $12.55. So in this case, we're going to look at selling a vertical. So what does that mean? When we short a vertical or sell a vertical, it means we sell it for a credit. And our defined risk formula for verticals when we sell them is our max loss is the difference between the strikes minus the credit received. What does that mean? Well, let's first take a look at how this vertical is set up. Here's a $12.55 call. In this case, we're going to sell the $12.55 call just like we did in our example of $100. And we're going to buy the next one up, which in this case is the $12.60 call. So we're selling the $12.55 call and we're buying the $12.60 call for protection. And by doing that, it's going to define our risk, as I'll show you in a second. And when we do this, we are selling it for a credit of $2.35. Okay, so let's go to the next page and really break this thing down. Okay, so let's dig a little deeper into this thing and really explain how verticals work. So remember again, our stock price is $12.55 and we're selling a call vertical. So we started out by first selling the $12.55 call. And remember, if we just sold that by itself, we'd have this undefined loss potential. But to protect ourselves, we're going to buy the $12.60 call. And when we do that, we're getting a credit of $2.35, which we all know options are times 100, so it's actually a $235 credit when we sell this vertical. So what does that mean? Well, let's go up here now and see how this defines our risk. So our defined risk formula is our max loss is the difference between the strikes. And what is that? Well, in this case, our strikes are $12.60 and $12.55. So the difference between those two is $5. And remember, everything in options is times 100, so the difference between the strikes is actually $500. Minus the credit received. What did we receive for selling this? We sold it for $235. So let's look again. Our max loss is going to be the difference in the strikes minus the credit received, which in this case is $235, which means our max loss is going to be $265. And if you look right here, you see it play out exactly as we've just broken it down. Our max profit is always what we sell it for, just like selling an option by itself. The most you can make is what you sell it for. Same with the vertical. The most you can make is what you sell it for. We're selling this thing for $235, which means the most we can lose, our max loss, is $265. And again, how do we work that out? It's the difference in the strikes minus the credit received. Difference in strikes, $12.60 minus $12.55 gives us a $5 difference in strikes, which is $500. Difference between the strikes minus the credit received gives us a $265 max loss. So you can see we've defined our risk, and if you look down here, our POP is still greater than 50%, which we love to see, right? So yes, it's a lot less than it was for the naked option, which was the 65% roughly, but in this case we're still above 50-50, and we're defining our risk here. So instead of this undefined number here, now we know the most we can lose if things go horribly wrong is $265. And again, this plays out into our rule number 1 with trading, which is if you can lose more than you can win, which you can in this case, right? You can lose $265 and the most you can make is $235, so you can lose more than you can win. Our POP has to be above 50%, and it is. It's 53 in this case. That is basically selling a call vertical and how it's broken down. So I also think it's important to understand how the profits and losses work for verticals, because this might look confusing to somebody that's never seen it before. You might say, Cal, I'm risking $265, but the most I can make is $235, which means looks like I can never make any money with this trade. But it's important to realize that verticals are not an either-or scenario. It's a sliding scale. So what happens when we sell a call vertical? Remember, when we sell something, we collect a credit. So when we sell this thing, we collect $235 out the gate. Doesn't mean we're going to keep it. Just means we collect it up front. Somewhere in this range is where this vertical will end up at expiration. So when I say it's a sliding scale, all I mean is we start at $235 profit, and when this trade is finished, we'll either be somewhere in this green area, which is profits, or somewhere in this red area, which will be losses, but the most we can ever lose is $265. So at expiration, somewhere in this whole range is where this trade ends up, and that decides on whether we have profits or losses. So it's not an either or. It's not either 235 win or 265 loss. It's somewhere on this sliding scale. And just like with any options, verticals have break-even prices as well, so it's entirely possible. at the end of this trade that we neither make nor lose money because there is a break-even price. But once again, just important to understand, verticals are a sliding scale. Somewhere in this range of this difference between the strikes, remember, $500 total is always the size of the trade. So if you add up profits and losses, it always has to equal the difference in our strikes. And here you see that. And somewhere in this range, like I said, is where you're going to end up at the end of this trade, either profits or losses. But the most you can make is what you sell it for. And the most you can lose here is 265. That's the important part to understand when you're dealing with verticals. So let's look at selling that naked call option, that 1255 option by itself, compared to now selling that call vertical. So in this case, if we sold the 1255 call by itself, obviously there's a lot more money to be made, but we get to this loss potential, which we now know is undefined. And you see here now it says undefined as opposed to unlimited. That's because, believe it or not, I spoke to the software developers and I told them that unlimited was a bad term to use. I thought undefined was much better, and they agreed with me. So from now forward, we're actually going to see undefined listed here as opposed to unlimited loss. So what's the upside for selling a call option with undefined loss potential? Well, we get this high POP. Those are the trade-offs, right? Undefined loss, selling the call option by itself, and we get this high POP. So let's go over to the call vertical instead and see how that plays out. Well, in this case, obviously the profit potential is much lower. We see that. But here's the beautiful thing. Our loss is capped, right? We know exactly how much we can lose. We no longer have this undefined loss potential. I know if things go horribly wrong, the most I can lose in this trade is 265. That is a great feeling because now I can sleep at night. I know if the whole market collapses, no matter what happens, I can afford, and if your account's big enough, to take this 265 loss. Whereas undefined, it could go into the thousands and it could bury us on one trade. And when I sell this vertical, I still have a POP of 53%, above 50%. And why is that? Because even in this case, my potential loss, I can lose more than I can win, which is rule number one. If you can lose more than you can win, our POP has to be above 50%, and it is. So that's a great feeling as well. So yes, understandably, the POP is a lot less than it is for the undefined risk option, but undefined risk again, right? That's a much scarier scenario, especially as beginning traders. We would much rather know, like, worst case scenario, what's the most I can lose? And now we do. We've defined our risk. We still have a good potential profit to make, but our risk is defined, and we still have a POP greater than 50%. And that's exactly why we sell call the verticals as opposed to selling just a naked option or an option by itself. Undefined risk, too scary. Defined risk, much nicer, and a POP still above 50%. Hey, those are all bonuses working in our favor as beginning traders. We love to sell verticals.